Good morning, everyone. Lovely to see so many faces in the audience. Thank you very much to the organizers for inviting me. And the reason I say that is because I am an economist. And economics has been defined as the science of telling you things you've known your whole life, but in a language you can't understand. So what I plan to do this morning is to talk to you about the global economy and energy. And indeed, it is a great question. It was actually the question posed to me by the organizer. So I thought this was a great challenge to think about the economic outlook and to think about energy broadly. You are all the experts in the room, so I hope that the economic analysis will be useful for you in thinking about how the energy mix is so essential to our continuing economic growth. So the very first thing I'm going to give you is a caveat. There's going to be many in this talk, but the very first one is I will be looking forward. So there will be a bit of economic forecasting, but let me just remind you of what the great economist J.K. Galbraith said, which is the sole function of economic forecasting is to make astrology look respectable. But we all have to do it. So I'm going to first look back. So this is a chart that goes back to the 1960s. And the host mentioned there, this feels a little bit like going back to school. There's going to be some charts, there'll be some statistics, there'll be a bit of math. But I want to remind you of another great economist, Joan Robinson, who said, I never learned maths, so I had to think. So what I want to point out here are just trends. But it goes to show the point that there has been a very close link between energy and specifically CPI, so consumer prices, and of course, inflation is closely linked to GDP, national output. So what this chart shows is in the 1970s, we had the first global supply-side energy shock, and there were two of them. One was from the Yom Kippur War in 1973-74. The second one was the end of that decade with the Iran-Iraq War. And that caused huge inflation spikes. And of course, stagflation became part of the lexicon, stagnant economy with high inflation. So we have had a number of shocks over the past few years, and they have not generated the same level of GDP impact. Inflation had gone up, but it does look like Mark Twain is right, which is history doesn't repeat itself, but it does rhyme. So the lessons that we would draw have to do with thinking about how to manage what looks to be supply-side shocks re-entering the system. And in fact, if you look at the close correlation between energy prices and inflation in the European Union, you can see when CPI, or CPI, which is the measure for Europe, when inflation is decomposed, you can see how important energy is as a driver, particularly of the spike, but certainly present if you look at the pre-pandemic period in terms of being a significant component of costs. But the implication also goes the other way. There have been a few times this year in which energy has been a negative cost contributor to overall prices and therefore inflation because of renewables. And to me, this is a just as important point to take forward. So as inflation has slowed, and we know the ECB has cut rates, interest rates, twice, and perhaps might cut it again next month, that's a reflection of both energy prices coming down and the pass-through, which is what some of the other components suggest of energy, have also moderated. So services inflation, that is the most important part of inflation for not just the European Union, but for most major economies. And that embeds within it the cost of running an office, the cost of running a conference center, which is also related to energy. So I would say in terms of the linkage, it's been very clear that the global economy, inflation has been closely linked to energy for the past few decades. And this is a trend which I think will continue. So what does that imply for our collective efforts? If you look at what European firms report as obstacles to investment, which is, of course, a key driver of economic growth, energy has been around the second, certainly in the top three, largest obstacles. So traditionally, these are academic surveys which are done on European firms. Traditionally, it's the availability of skilled labor, appropriate workers, and uncertainty. Those tend to be the two reasons why firms may not invest. So the inclusion of energy is because of the last few years, and what that suggests again is thinking about how to essentially manage the energy trilemma, which is energy security, energy availability, energy affordability, as well as, of course, sustainability. And that also feeds into uncertainty. So a lot of the linkage is through how it affects firm behavior. And so I think there is, again, a real indication that we need to think hard about energy policy and the push towards renewables to both reduce uncertainty, reduce costs, and of course we're here at the World Hydrogen Congress, and I think this is another reason to think about the positioning of hydrogen within the overall mix. So here's the growth projection for the next year, and remember I already gave the caveat about forecasts. So what this is saying is, taking together what I've said about energy costs, interest rates, and inflation, the world is expected by the International Monetary Fund to pick up in growth next year. This is driven by a movement of interest rates, not just in the Eurozone, but also in the United States significantly, away from restrictive rates, which is increasing the cost of capital, the cost of borrowing, and towards a neutral rate. So that shift means at the moment, the restrictive rates are causing quite weak economic performance, or certainly a contributor. So for instance, Germany has had another quarter of contraction in its economy, and the slow growth expected for the next few months is reflective of the rate easing cycle just beginning to start. But next year, the pickup in growth, not consistently, but certainly evident in the euro area, is monetary policy easing, is reducing the cost of borrowing for firms and households, and you should begin to see an uptick in terms of growth on the back of that. So what could derail it? There is not enough time to talk about all the things that could derail it, but I'm just going to focus on what I have honed in on, which is the importance of energy costs. So what we have at the moment, and just worth reminding ourselves, the pandemic in 2020 caused price shocks because of disruptions to supply chains. The Russia-Ukraine war in 2022, in February, that was another cause of a commodity price increase, energy as well as soft and hard commodities. What we haven't seen so far is the same kind of price increase on the back of the Israel-Hamas war, and that in October 2023 is almost exactly 50 years to the date of the 1973 Yom Kippur War that I mentioned at the start. That tension that has the potential to generate another supply-side energy shock because if it spreads into the wider region. And what we know at the moment is that there is, of course, disruption to shipping because the Iranian-backed Houthis in Yemen have been disrupting shipping flows. So that is one big geoeconomic risk so far that's affected the cost of transport, but it hasn't generated a wider energy increase, and it's been about a year now. So that is just one risk to watch out for. And I want to move to another risk, which is, of course, China. China is the world's second biggest economy. Its growth significantly impacts, of course, the world economy, as well as global prices. So Chinese demand for commodities has been a big driver of the increase in commodity prices over the past couple of decades. China's deflationary stance, so that means prices in China roughly falling, certainly not growing very quickly, is a reflection of the slowing economy, and that also has an impact on global prices. So you do have positive price spikes, but you also have deflationary pressures coming from the world's most populous nation. So the question here is, how long will that last? And at the moment, China's economy is growing more slowly than before the pandemic. What's not clear is how much of that is cyclical and how much that is structural. So cyclical means China is coping with a massive property bust. So it's cyclical in the sense that it's denting consumption because the biggest asset owned by households is property. To give you a sense of how important property is to the Chinese mothers, there was a survey done recently that found that 80% of Chinese mothers would not approve of a marriage of their daughter to someone who didn't own a flat. So the impact, the negative wealth effect, has caused an increase in Chinese savings rates, and until the property sector is resolved, that will dampen growth. What isn't clear is how long that will take. So the property bust has already been going on for about 3 years, and this is where concerns arise about whether or not China is looking like Japan after a property bust. The other reason is structural. So China's growth, as you can see there, used to be double digits. As China has become an upper middle income country, growth isn't expected to be that fast. The average growth rate for emerging markets is 5%. The average growth rate for advanced economies is 1% to 2%. So we do expect a slowdown. We just don't know if it's cyclical or structural, something to really worry about in terms of China, or something which is just part of the course of becoming an upper middle income country. The implications, of course, are significant as to how China manages this structural change. For instance, it has spent a great deal of money, not just recently on stimulus, but it has spent a massive amount on the Made in China 2025 plan, which is focused on Chinese investments in key technological sectors, and a lot of it is in the green transition. And so China looks like the US and the EU in focusing on putting investment and subsidies behind the net zero transition, and that will also impact, of course, your sector and the global economy if it pays off in the future. So even as China slows, the quality of its growth going forward will become even more important in terms of what growth will look like in the next few years. So you can't do the world economy without geoeconomics, and so this is when geopolitics affects economic policy. So what this chart shows is the US and China being the top trading partner in terms of manufactured goods. So what you can see is China has gained a large number of countries over the past 20 years or so, that for whom it is the biggest trading partner. The United States has lost its number one position, but of course it's still a major trading partner, particularly in East Asia and the Pacific, as well as Sub-Saharan Africa. So what this is suggesting is if U.S.-China tensions continue and there is a fragmentation, not a deglobalization or bifurcation, but a fragmentation, that does, again, potentially add to supply chain costs because global value chains will shift, and that could also increase inflationary pressures. And so this is just another factor to bear in mind. The question I often get asked on the back of geoeconomics is, where will this end up? And the answer is, the U.S.-China trade war isn't really just about trade. It's not really about technology. It's about power. So a U.S. Treasury Secretary said to me once, for an American, in their heart of hearts, they would really just like to be the G1. And for China, the Chinese often like to say, if you do business with them, it's a win-win. That normally means that China wins twice. I also just want to touch on another factor which could impact the global economy, of course, which is debt levels. And I've used the U.S. Debt levels here, using public debt to GDP. So it's a broader measure than what you sometimes see. So as interest rates go up, you can see, going back since the 2008 banking crisis or so, there's no real correlation between the debt level and interest rates. The U.S. does tend to be a slightly different creature. Not to say we shouldn't worry about public debt, but what this is suggesting is we have had a massive expansion of public debt, not just in the U.S., but certainly in Europe and elsewhere. And as rates go up, it could put pressures, particularly on countries which have borrowed in U.S. dollars. But what this suggests for monetary policy is, normally monetary policy reacts to fiscal deficits. So the fiscal deficit is large or financed through borrowing. It's inflationary. That can cause central banks to keep rates longer, higher for longer. So the terminal rate or the neutral rate will be impacted by the amount of debt as well as structural growth. So as rates begin to come down in the U.S. and certainly, as I mentioned, in Europe and elsewhere, we don't really know what the new neutral rate is, but it's likely to be higher than what it was before. So before 2008, interest rates were around 5% in the U.S. The real rate, therefore, was 3% or so. That may or may not be what it is going forward. So that's just something else to bear in mind. I want to move to a few slides on energy and then take any questions that you might have. So despite what I've just said about high deficits and debt, perhaps constraining the ability of governments to invest, what we have seen in the EU is the Green New Deal. In China, I've already mentioned the U.S. Inflation Reduction Act. There's been quite a lot of impetus behind greening investment. And what you see is global investments in energy have continued apace, particularly clean energy. And that is helped by public investment, well, certainly by the investment regulatory framework. But what it suggests is there is a real momentum behind the move towards a green transition. And you see it if you follow the money. And I think that's what this chart, I think, positively indicates, that despite everything that I just said, I think there is a real push towards cleaner energy investments. So what could hold this back? One big factor is the global divergence in emission schemes. So what you see is in Europe, parts of Europe, you've got a carbon tax and you have an emissions trading scheme, the ETS. So if you wanted to have a consistent framework, you would either regulate the price or the quantity of the good that you're trying to regulate. So that would either be a carbon tax or an emissions trading scheme, which is quantity-based. What you have are different schemes in different parts of the world. So you have, for instance, ETS in China. You do have a carbon tax, as you can see from this chart, in some places. It's, well, I was going to say the most apparent, glaring, non-colored maturity is the US. So economists generally, and in fact the head of the World Trade Organization recently has proposed a global carbon tax. And that may or may not be the way forward, but what it is saying is you need a global framework to reduce uncertainty, and having fragmentation is not going to reduce that important factor, which all of you will be very familiar with, which is policy uncertainty in impacting investment. So whatever it is, I think it needs to be something which is much a greater focus of policymaking, which, by the way, given what I just said about the global economy and its fragmentation, is challenging, but it's not impossible. So recently, the World Trade Organization had a breakthrough in terms of updating the Trade and Services Agreement, which hadn't been updated since the WTO came into effect in the mid-1990s. And of course, we know the world has moved on a lot since then. It was an effort led by a group of countries, European countries in particular, but the US and China both joined later on and signed up to it. So I'd like to think that when it really comes down to the need for a global framework, the superpowers understand this, which is, if you're not at the table, you're on the menu. It's in their interest to be at the table, to participate in rulemaking, and I think this, to me, is why we shouldn't be disheartened by the US-China rivalry in terms of the global economy. However, that being said, I want to finish with a few thoughts on the net zero challenge. The very first one is actually the disparity in terms of green funding. So Europe actually comes up short in terms of the financing disparity. This is clean technology, venture capital, and growth capital funding. And what you see is over the last few years, the United States, in particular, has been racing ahead in this area. What's notable is that Asia has also invested quite a lot, and China is a big, as I say, part of that. By some metrics, China has invested more renewables than other countries in a given year. So the European Union has lagged behind, and I think this is a real important call to think about what is actually holding back private capital in terms of clean technology and green investments in this region, given that the EU is actually a leading player in ESG, environmental, social, and governance criteria to make sure that firms are setting their own net zero targets as consistent with the Paris Accord. But this, I think, is something which is important, again, as a call to action, if nothing else. There are, of course, structural differences. There's a lot more VC money. There's a lot more private equity money in the United States. US firms, unlike European firms, have been able to scale on a much bigger basis, which of course means they can take in more funding. So it's not just a question of policies around energy. There are broader questions around the regulatory regime, capital markets. The US has a much bigger capital market than Europe. The mix is 80-20, capital markets to banking. In Europe, it's in reverse. It's 80% banking, 20% capital markets. So there are some reasons as to why the US, unsurprisingly perhaps, gets more VCPE funding into clean technology. But I think what this is suggesting is unless more money is allocated in the EU as well as in Asia, it is going to be hard to hit net zero by 2050, which does require a much greater use of renewables versus our current energy mix. So, to conclude, and then we have a few minutes for questions, the global economy will be linked with energy, but the energy mix is already changing quickly. Some obstacles and challenges there that I've highlighted, but the trend suggests that we are moving towards a cleaner energy world. The macroeconomic environment and the global policy regime unfortunately add uncertainty, but I would say the trend towards greening the economy continues apace because of dedication from people like you and a lot of my students who really can't quite understand why we're still having this discussion rather than just acting, which I think is a really important point, that your consumer, your customers, this is what they're after. And I think that's what's driving a lot of the momentum despite the politics. So we have a few minutes for questions. Very happy to take any that's come through on Slido. Okay. Oh.
Let's take the first question. We see massive oversupply of LNG from US to Qatar between 25 to 30.
Yeah.
We're already seeing the prices of oil due to EV in China. How is that impacting?
Yeah, so I think there's no reason why the energy mix would affect the growth rate. So the transition has a cost, and that could impact, for instance, that has an impact on firms, therefore it could impact in the short term on growth rates, but it shouldn't impact growth in the longer term. In other words, in the 19th century, I've written a lot of economic history books. The predominant energy source was renewables. It was when cheap coal and oil was discovered, then that changed the energy mix. So there's no reason why after we make the transition, we shouldn't see growth pick up because you could have much greater efficiencies on the back of using renewables. So when I mentioned there energy prices contribute negatively to inflation, the converse of that is a positive impact in terms of growth because rates can be a bit lower. Okay.
Should we try the next question?
Sure, yeah. Okay. So does a successful energy transition have to be tied to economic growth? What are your thoughts on pushing down degrowth and lessening emphasis on GDP? So a successful energy transition will be tied to the quality of growth. And this is why I was suggesting as we change the mix, it isn't necessarily how fast you grow, but it's how well you grow. However, if you want to fund public services, you do need to grow because you need tax receipts. And so I think there is a real debate around the usefulness or not of GDP because it's just an aggregate measure. It doesn't capture things like quality or inequality. GDP per capita would be a good measure that would strip out things like, decreases in population or increases in population. So I do think the quality matters a lot more than the quantity. And I think that will be linked to energy. Okay. The next question, these are great questions, by the way. A colleague told me ET will result in war. Africa has better conditions in the second half of this year. China, Russia controlling critical metals. EU, US don't like this comment. Okay. Africa has, if you think back to the growth forecast, it is, I think, turning a corner in the same way the rest of the world is. China, Russia controlling especially critical materials, and in China's case, the processing of EV batteries, massive issue. So even if the US and the EU are successful in their green transition plans that I described, 80% of all batteries will still be processed in China by 2030, according to the IEA. So this is one of the reasons why I hope they will actually come to the table. Next question.
Now, I think we'll pause here in sake of time. So thank
Okay.
you very much to Linda. Can you give her a hand?
Thank you very much.
Thank you.
Yeah. Let's go.